You know that feeling when a stock is everywhere? Everyone's hyping it up, but then it just kind of fizzles out? It feels totally backwards, doesn't it? Well, today we are diving headfirst into that exact puzzle. We're going to look at the weird, surprising link between good vibes and bad returns, especially in the red-hot market for green stocks. Let's get into it. So this is the big question, right? It's a real head scratcher that goes against a lot of what we think we know about investing. I mean, if everybody loves a stock, shouldn't that just push the price up and lead to awesome returns? Well, as it turns out, the real story is way more complicated. And the answer, it's definitely not what you'd expect. Okay, so before we can even begin to connect mood with money, we have to tackle a huge challenge. How in the world do you measure something as fuzzy and abstract as investor sentiment? I mean, how do you put a hard number on hype or excitement or even fear? Well, researchers have gotten incredibly clever about this. The study we're digging into today uses this really smart two-pronged approach. Think of it as what investors do versus what they say. Over on the left, we've got trading sentiment. This is all about the hard data, the numbers, things like PE ratios and trading volume. They take all that info and crunch it down into a single score. Then on the right, you have internet sentiment. This is what investors are actually saying online. And they got this from a massive data set, almost 2 million posts from a huge Chinese stock forum. Now, this is where it gets really cool. The tech they use to measure what investors say is just fascinating. It's a specialized AI called Finbird. And listen, this is not your everyday chatbot. This thing is a specialist. It's been trained on millions and millions of financial documents, so it understands all the jargon, all the slang, all the little nuances of financial talk. This allows it to scan those millions of forum posts and figure out if they're positive, negative, or just neutral with some serious accuracy. All right, so we've got our mood measuring tools ready to go. Now, where do we point them? The researchers chose a really specific, really high-stakes arena to test all this out, the world of green finance, a market that's really driven by both passion and policy. The whole experiment zeroed in on this number, 78. 78 Chinese stocks that are all connected to carbon neutrality. So we're talking about companies in new energy, environmental protection, you name it. It's the perfect test case, really, because these are exactly the kind of stocks that get people really excited and generate a ton of buzz online. And you have to look at the timeline here for some crucial context. This study didn't just happen in a quiet little lab somewhere. Oh no, it ran smack dab through the beginning of the COVID-19 pandemic. And on top of that, it also captured a massive policy announcement from China that sent interest in these green stocks through the roof. So yeah, this data got put through a serious real-world stress test. And here it is. The big one, the core finding, straight from the researchers themselves. After all that work, all that analysis, the result was crystal clear and totally counterintuitive. It didn't matter if they looked at what investors were doing with their money or what they were saying online. Higher positive sentiment consistently led to lower future stock returns. So the billion-dollar question is, why? This is the part of the story where we get a major plot twist. To solve this puzzle, we actually have to stop looking at investor psychology for a minute and start looking at the nuts and bolts of how the market works. There's this hidden factor, this sort of middleman that connects all the dots. So let's just ask that question one more time to really hammer it home. How can good vibes possibly lead to bad returns? Well, the answer has everything to do with how easy it is to buy or sell a stock, a concept that finance pros call liquidity. So what on earth is liquidity? Okay, let's make it super simple. Imagine you have a $100 bill. You can trade that thing anywhere, anytime, right? It's super easy. Now, imagine you're trying to sell a giant antique wardrobe. That's gonna take some time. You need to find the right buyer. The $100 bill is highly liquid. The wardrobe, not so much. It's the exact same on the stock market. High liquidity just means it's super easy to buy or sell a stock because there are tons of people ready to trade. And that idea leads us right to another key concept, the liquidity premium. Look, if you're going to take on the hassle of owning something that's hard to sell, like our antique wardrobe, you expect a little something extra for your trouble, right? A higher potential payday. Stocks are no different. Investors demand a potential extra return, a premium, for tying up their money in a stock that's harder to sell. Okay, so here's the play-by-play. This is how it all connects in a clear chain reaction. Step 1, a stock gets super popular. The sentiment is through the roof. Everyone's buzzing about it online. Got it? Step 2. Because everyone's talking about it, they're also trading it a lot. All that action makes the stock incredibly liquid. Easy to buy, easy to sell. And now for the big twist, step 3. Because that stock is now so easy to trade, that little bonus, that liquidity premium you got for holding a risky, hard-to-sell asset, poof, it's gone. The extra reward disappears, and that leads to lower future returns. See the connection?
And this isn't just some abstract theory. They could actually measure it. The researchers found that this whole liquidity effect accounts for 5.72% of the negative impact that trading sentiment has on returns. Now, that might not sound like a huge number, but it's a real, statistically significant piece of the puzzle. It proves this mechanical effect is actually happening.
Now, remember how we said this whole study happened during a time of extreme market stress, the COVID-19 pandemic? Well, that gave us this unique, if unfortunate, chance to see how this whole relationship holds up when things get really crazy. And wow, the data here is just striking. Look at the bar on the left. That's the negative effect of sentiment on returns before the pandemic. It's definitely there. But then look at the bar on the right. That's the effect during the pandemic. The negative impact got so much stronger. In other words, when things got chaotic, good vibes became even worse for your returns. The researchers really didn't mince words in their paper. They put it bluntly. During that crisis, the market just became way more sensitive to these mood swings. You could say the emotional side of investing got turned up to 11. So why did that happen? Well, think about it. In times of extreme uncertainty, when panic and rumors are flying everywhere, we humans tend to fall back on our emotions instead of cold, hard logic. And that psychological state just amplified the power of sentiment, making its effect on the market's mechanics even bigger. Okay, so we've untangled this really interesting paradox. But what's the big takeaway here? How can you actually use this information, whether you're an investor or just someone trying to make sense of the modern economy? Here are the big takeaways. First, for investors, the message is loud and clear. Be careful about jumping on the bandwagon. When a stock is the talk of the town, this research suggests that might actually be a warning sign of lower returns coming down the pike. Second, for regulators, this really shows how important it is to keep an eye on that online chatter to help keep the market stable. And finally, for the market as a whole, it's a powerful reminder that keeping things liquid, especially in a crisis, is absolutely critical. And all of this leaves us with one final big question to chew on. In this age of endless online chatter, of social media and forums and instant news, we really have to ask ourselves, are we heading into an era where the market is driven less by the numbers on a balance sheet and more by the collective and, let's face it, often unpredictable moods of the crowd? It's definitely something to think about.